Hi again, welcome back to my channel. My name is Sandy Swamdwini. Today I am going to be talking about commission earners and tax. So one of the popular industries where there's commission earning is real estate. So if you're a real estate agent, this is the video for you, or you're locum, this is the video for you. I'm going to be talking about all things commission earning, and I will be dishing out all the tips that you can use. Okay, firstly, I would like to address all the misconceptions about commission earners out there. Number one, commission earners are not taxed more than anyone. They tax in the same way as the people who earn the 9-to-5s. They tax in the same ways as the people that have businesses. They're basically taxed the same way as all the other people. Yes, the way of taxing, they might be different. There might be other methods that I will discuss in this video, but they are taxed equally. Let me just put that out there. This misconception that commission earners are taxed more and whatnot, I think it just comes from from people not understanding the way that tax on commission is calculated, which is something that I'm going to be discussing on this video. In other words, tax on commission is exactly the same as tax on fixed salaries. It's exactly the same, not more, not less. Yeah, fine. Okay, so now that I have cleared all that up, I would like to explain what causes the confusion between fixed salary earning people as well as commission earners, or what makes people think that commission earners are taxed more. Now, one of the reasons that causes the confusion is that tax on commission earners is calculated on a different amount each month, because remember, commission earners can never earn the same each month. It's different depending on their performance in their jobs and depending on how the economy is doing and whatnot. So their income fluctuates. In other words, the income is not the same every month. So you will find that tax is calculated on different amounts each and every time, which is what sometimes causes the confusions between the tax on commission earners as well as the tax on fixed salaries. Over and above that, you will find that different companies use different methods in order to calculate the tax on commission earners, even though most of the cases it amounts to the same result. Different companies use different ways of calculating tax, which are all correct, by the way. It's just that it's just different ways of skinning the cat. At the end of the day, the cat is going to be skinned. It's just that you're using different methods of calculating. So I am going to explore those methods and hopefully clarify all the misconception that is out there. Now, the first method that companies use in order to calculate tax on commission earners is the aggregated annual tax method. When using this method, companies take your monthly earnings and they multiply them by 12 in order to get an estimate of what your annual income will be, and then they apply the tax rate on that estimate. Now, the danger of using this method is that, one, they might take your lowest month. Say, for instance, they use March is because the tax year starts in March, and your March was the poorest of your months. What's going to happen? You're going to owe tax at the end, because remember, say for instance in March you earned 3,000 Rand in commission, and that was used to calculate your annual tax payable. And then you find that in the months following March you made 4,000, 5,000, 6,000 Rand, and however your tax was calculated on that 3,000 Rand. So the dangers of that is that you find that most people end up owing SARS at the end of the year. However, one of the ways in which you can use this method, but try by all means to stay accurate so that the person doesn't end up owing taxes at the end of the tax year, is to actually reevaluate the taxes that you are deducting each and every month. It's a lot of admin, it's a lot of work, but rather than owing SARS a lot of money at the end of the tax period, you'd rather do that than, in fact, you as the taxpayer do that, not the company. Reevaluate the tax that you're paying and check, is the tax that you're paying still in line with the income that you're earning? And if you see that it is not, then adjust and adjust as the time goes by. And you can see, and if you can see as well that the money that you made in the beginning is way more than what you're making now, then you can even go pay provisional tax. Go pay provisional tax, but that's something that I will discuss towards the end of this video. Now, another method that companies or individuals use in order to calculate taxes for commission earners is using a tax directive. A tax directive, first of all, you apply for a tax directive. So yeah, you apply to SARS for a tax directive each and every year. You do that yearly because the years are not the same. Now, what is it? A tax directive is an instruction. So you apply to SARS and say that SARS, please issue me with a tax directive. It's an instruction from SARS after you've applied, obviously, to your employer to deduct your taxes at a fixed rate. In other words, you put in all your information on the tax directive, and then SARS looks at it and they do their own calculation and they give you a set tax percentage that your employer can deduct taxes from your commission. That's what a tax directive is in simple terms. As mentioned already, in order to get your tax directive, you need to apply to SARS. Normally, they want supporting documentation such as your earnings as well as your expenses. Now, most people, when they are applying for tax directives, bazikhanda ngelitye enweni, because what they do is they understate their incomes and they overstate their expenses, and that doesn't help anyone because at the end of the year they end up owing SARS money. Don't do that. Be honest on your application, on your tax directive. Dishonesty doesn't work for anyone because at the end of the day, if you earn that income, you're gonna pay tax on it, and who's gonna end up owing SARS? You. Tell the truth on your tax directive. It's good for you. It's for your own good. When you're applying for a tax directive, SARS doesn't consider your application if you don't provide them with all the information. Because remember, they need your earnings, they need your expenses, and they need, perhaps they might even ask for supporting documentation in order to support what you've written on your application. So if you don't give them all the information that they're asking for, then they will not consider our application, or your application will not get anywhere. So that's very, very important. Remember as well, very, very important, a tax directive application is based on an estimate. When you're doing your application, you are doing it based on an estimation of your incomes and expenses. Now, for someone who has been in that business, now if you've been a real estate agent for 5-10 years, it might be easy for you to do your estimations and whatnot, but for someone who's starting out, it's very difficult. So that's why it's very important to actually do your research when you are applying for your tax directive, because if you don't, then it becomes a problem. Now, as mentioned before, a tax directive is only based on an estimation. So the only way to know for sure whether or not you owe money SARS is after you've submitted your annual tax return and gotten back your assessment. So again, it's always advisable that you actually check out if you've seen that in the previous years you ended up owing money. Then it would be advisable for you to actually see if you can't have SARS adjust your the tax directive that they actually did for you, or adjust the percentage that your tax is being deducted by your employer. Very, very important. That's if you don't want to end up owing SARS, because for me, I'd rather SARS owes me than I owe SARS. I don't know about you. Again, as I already mentioned, for someone who's starting out, it's very difficult to estimate, but a tax directive I've seen works better when someone has a track record. In other words, they have a track record, number one. Number two, the difference between their monthly commission isn't much. In other words, the 1 month you do 4,500 rand, the next month you do 5,000 rand. So the difference isn't much. So you will see that, okay, then my income is more or less the same this month, this amount. Now, in instances where the income received on a monthly basis is less stable, then it is probably not a good idea to use a text directive as a form of being taxed by SARS. So in that situation, a text directive is not a good idea if there are big fluctuations between the income that you earn on a monthly basis. Then a text directive is probably not a good idea for you. Then you would need to consider other ways of actually calculating your tax payable. Because if you use a text directive and yet your income is fluctuating, chances are there will be a tax owing at the end of the tax period, and we don't want that. We don't want to owe SARS at the end of the tax period, because that's not nice, and most of the times there are cash flow problems and people are unable to pay. So rather avoid a tax directive altogether if the fluctuations on your income are just big. Please also note that a tax directive is valid for a period of 12 months. In other words, each and every year you have to apply for a new tax directive. Or if you change employees during the year, then you still need to go apply for a new tax directive, because you can't use the one tax directive for the one employer and then move on to the next and then use the same tax directive. Unfortunately, it does not work that way. So changing of employers, new tax directive, new year, new tax directive. Now, the third method that we'll be looking at that is used in order to calculate tax for commission earners is the annualized amount of tax payable. This one is the least popular way of calculating tax, but it is the most accurate. Least popular way, most accurate. Least popular because it is very complicated and most people can't get it right, and most companies just prefer to use the text directive or the first method that I explained. So this one, basically, you work out the tax average on your monthly income. Step 2, you multiply whatever you got by the number of tax periods. In other words, if you worked for 7 months, you multiply that by 7 months, and then you subtract the tax that you've already paid. I know it sounds complicated, but if you go consult someone, or if you sit down and actually listen to what I'm saying, or you write it down, it's going to make a little bit more sense. Firstly, multiply tax on average monthly income. Number 2, you multiply that by the number of tax periods. You subtract what you've already paid for tax. In other words, if there's a little bit of tax that's being deducted there and there, you subtract all of that. Lastly, after you've done your subtraction, the remaining amount is what you will be deducting from your taxes. I hope that calculation made sense. Now I'm going to move on to all the expenses that commission earners can deduct. When I say commission earners, please note that I'm referring to people whose commission income makes up more than 50% of their total income. If your own income in total, including non-commission income, is 10,000 Rand, that means that at least more than 5,000 Rand of that is from commission. This is the person that I'm referring to when I say all the expenses that you can deduct. If your commission income is 50% or less, then unfortunately you can't use these deductions at the moment. The first deduction that you can make is for a car allowance. Now you can only do this, please, very important, you can only do this if you keep a logbook. Logbook, very important. Keep a logbook, and it must be up to date, you guys, because SARS just doesn't accept logbooks that are fictitious logbooks that are made up. And SARS, they have now skills. The people are skilled in looking and auditing logbooks just to see if it's fictitious. So very important, complete your logbook. If you don't know how a logbook should look like, then go to the SARS website. They have a logbook there. And if you use that one, even better, because then there's not going to be problems. I know in our days people have logbooks that attach their cars and whatnot, fancy logbooks, and there's absolutely nothing wrong with that, but as long as it will have all the information that SARS requires. Super important, because SARS wants to know who you went to see, why you went to see them, how far they are, and all those details. SARS just wants all of that. I know it's petty, but that's what SARS wants, and I would advise that you give SARS what they want if you want your refund. Now, the second expense that you can deduct is wear and tear or depreciation. This is now wear and tear or depreciation of an asset that is used in your earning of commission income. This could be your laptop. I know most people have laptops, or your cell phone. Guys, you can depreciate your cell phone. You can depreciate your laptop, especially because the cell phones now, they're so expensive, very expensive. You can depreciate them, and you can deduct that from your commission income to decrease your tax payable. Lastly, home office expenses. Now, I've done a video dedicated to this home office expenses because it's such a broad topic, and there are a lot of home office expenses, and you just don't deduct nje. There's a criteria that needs to be followed in order for you to be eligible to deduct those home office expenses, or in order for those home office expenses to be deducted from your income. There's a criteria that you need to meet first. So I've done a video on this. Please go to check it out. I will also leave it on my description. Lastly, guys, which is very, very important to remember, claims need to be apportioned. In other words, if your cell phone, you use 80% of it for private and 20% of it for business, then you can only deduct 20% of that cell phone bill, guys. Don't treat SARS, because SARS will come for you. And unfortunately, when SARS comes for you, they don't come for that year only. They go the previous years, because in their minds, they're thinking, oh, if this person did this year, which means that they've been doing it in the previous years as well, and they've been getting away with it. So SARS, normally, when they red flag you, they go all out. They check the previous years, and it just becomes a mess. And in most cases, really SARS sees that things that they're not supposed to see. So you don't want SARS on your back. In fact, you just don't want SARS to start on you, because once they start on you, unfortunately, they never stop. You'll find that you never used to get audited, and all of a sudden SARS audits you every year because of one stupid little thing that you did. So don't do it. Don't try to cheat the system. Don't leave all of that for criminals. You're not a criminal, right?